So we are going to share ideas about this standard. Okay, with financial instruments here, we are interested in 3 standards. One, you will be looking at the IFRS 9, that is financial. It's the one that talks about actually financial instruments. It replaced IS 39. It replaced IS 39. Then you have IS 32. Then you have IFRS 7, which is a disclosure of financial instruments. So these are the standards that you must at least know. But what is the financial instrument? What do you understand with the financial instrument? What is all about financial instrument? Here, what are we talking about? Financial instruments. What are these financial instruments that we are talking about here? We talk about these things. Of course, you need to understand also what is your financial asset, what is your financial liability. Understand the financial assets. Okay. Understand the financial liabilities. Okay, the financial liabilities. Then understand the equity instruments. Then also understand the compound financial instruments. Now understand the measurements, the measurement criteria. Here on financial assets, we need to know the measurement criteria, which is very, very key for calculation purpose. And also understand the part of impairment and also the reclassification part as you read the classification part. How do you reclassify these assets? Okay, also here with financial liabilities, understand the measurement criteria, and also the hedging part, the hedging accounting. Also here, equity instrument, understand the measurement criteria. And with compound instruments, compound financial instruments, we are going to talk about them. Those ones, you find that they result into equity and the liability. And we are going to talk about them under IS 32. Okay, now, with this standard, it's good to know you are in the books of the issuer or the holder. It's good to know. Otherwise, you can make a mistake. You need to know who is recognizing an asset. Is this entity which you're talking about to recognize an asset or a liability? Something that you must know. So you will need to know who is the issuer, and who is the holder. Who is the holder? Who is the holder? Okay. The issuer is the one who giving out, for example, the bond. Giving out the bond. like the government. Look at like the government, government bond, or a company can also be given the bond. Okay. Okay. Then that is the issuer, and of course they are going to receive. They receive money. They receive money from the what? From the public. Okay, they give out the bond and receive money, cash, okay, from the what? From the public. That it's like they have borrowed money from the what? From the public. It's not government's money. It's not government's money. So you'll find that this issuer is borrowing. So it's like here the issuer is borrowing money from the what? From the public, and promising to repay it with what? With to repay it with with interest. Okay, so what does that one mean? It means that issuer is the same as borrower. Issuer is the same as borrower. Okay, you issue, you give out the bond, but as you give out the bond, it means that you are receiving money from the public. That money is not yours. It's like you're borrowing from the what? You're borrowing that money from the public. That's why we actually say that issuer is like the borrower. Okay, then who is the holder now? Who is the holder? Okay, because once you understand these ones, you will be knowing how to interpret. You are in the books of the holder or the issuer. Okay, so who is the holder? The holder is the investor now. The investor or the buyer who holds what? Who holds the bond? Who holds the bond after buying it? Holds the bond after buying it. Okay, the government has issued the bond. Okay, you're the one who actually bought that bond. You are an investor. So it means that you are the holder. You gave out the money. Yeah, here the holder gives all ends, gives money to the issuer, the one who issued this bond. So it's like you're lending. You are the holder. You're lending. So they are entitled to receive. So here he gives, it's like lends money to the what? To the borrower. So they are entitled. They are entitled to what? To receive. They are entitled to receive interest. The holder is entitled. Holder is entitled to receive interest and his money and the principal. At the end, the government must pay back that money. So in simple terms, also here, the holder is like the lender. Is like the lender. Okay. Calculation questions. Here, are we together?
Yes.
Now, the question is, who will be recognizing the financial financial asset who will be recognizing the financial liability. The holder here, you should recognize, must recognize here, he must recognize the financial asset in his books. Okay, then here the issuer must recognize the financial liability because you're a borrower. So if you're a borrower, then you must recognize the financial liability. Financial liability in his book. In his statement of financial position, we must see that item, financial liability. I must say that. Remember, these ones must have their separate line. You don't mix, you don't aggregate with others. Okay. Okay. So I believe now you understand. So as you read the question, you need to know whether you are in the books of the borrower, if you are in the books of the holder, or what we call the lender. Okay. Now, what are some of the examples of financial assets? Examples of financial assets. What are some of the examples of financial liability? If it's loans and advances in the books of the bank, isn't it an asset? Huh?
Yes. Understood.
Okay, understand everything. How are these financial assets measured? If it's a financial asset, how is it measured? Initially, that if it's a financial asset, initially financial assets are measured at what? Are measured at fair value. That is according to according to the standard. The fair value of the consideration paid, then plus the transaction costs, transaction costs. The fair value here, it's like the price paid to acquire the bond. The price paid to acquire that asset. Okay. So transaction costs, those could be like legal fees, the professional fees. Okay. And it all depends on the criteria you are using. If your financial assets are measured, if the financial assets are measured at fair value through profit or loss, then the transaction cost must be expensed. So it depends on remember we have three things that we talk about. So if you say initially the financial assets should be measured at fair value, then subsequently what happens? Subsequently, it all depends on you as the company. Which model are you using? and the reason why you're holding that asset. Let me just say subsequently, you must know whether subsequently these financial assets, financial assets, these financial assets should be measured at either you look at it can be the amortized cost, or it can be the fair value through OCI, the fair value through OCI. Then it can be the fair value through profit or loss. Fair value through profit or loss. Now, how do you know that you're going to measure at amortized cost? How do you know that you're going to measure at fair value through OCI? How do you know that you're going to measure at fair value through profit or loss? So you are the company. You must choose. You must choose the choice of the measurement criteria. Here, it depends the choice of the measurement criteria depends on what? Depends on the two things. One, you look at your business model, your objective as a company. Business model, is it the business model for your business model, or your objective for managing or holding the financial asset? It will give you, are you just buying and selling? Are you buying and selling? Is that your objective? Is it that you're going to buy and just wait the maturity period to earn the interest? So it will depend on your business model. Then number two, it can also look at the contractual characteristics of your cash flows. Okay. Is it only about the interest and principal? What do you expect to receive? You can only use amortized cost if the financial asset is held for maturity. Correct, you are going to, at the end of the maturity period, you're going to correct the contractual cash flows, the contractual cash flows. Here at the end of the maturity period, you will have the interest. That's what we are meaning. Interest and the principal. If that is your arrangement, then here subsequently you must measure at amortized. You must measure at amortized cost. You're just holding that asset. You're just holding that asset to receive interest and the principal at the maturity period. Okay. That there you measure using the amortized cost approach. Then for fair value through OCI, it's used. This is used if your financial asset is held correctly to correct the contractual contractual cash flows, yes, like amortized cost, but here there is this word and sale. Here it means that here you can sell at any time. You don't want to wait up to the maturity period. That's where the difference is. Here the maturity period matters. Here is amortized. You expect, of course, you're going to correct here you're going to correct you're going to receive the contractual cash flow like interest and principal, but only at maturity period. That's when you expect that. You expect that. But here with this one, a fair value through OCI, you can sell before here. Here you can sell. Here you can sell. You can sell before the maturity period. But here you have to wait for the maturity period. So in the question, you have to be careful and see whether this asset is held up to the maturity, is it to be held up to the maturity period, or it can be sold at any time, even before the maturity period. If you see that kind of language, that the asset can be sold even before the maturity period, then it means that subsequently your financial asset must be measured at fair value through OCI. Okay, then with fair value through profit or loss, fair value through profit or loss. Here this is used. If the financial asset is held for trading. For example, like shares. Like you invest in shares. When you invest in shares, basically, for you here, you simply buy. Your objective is to buy. You're buying it and basically the dividends. The dividends. Here, nothing like the maturity period or what. It's like just here you're investing you're buying shares in a company. You are an investor. Basically, you're just going to wait to earn your dividend. Okay. So those are some of the things you must know. For example, here when it comes to amortized cost, you look at like treasury bills. Look at like treasury bills. You buy for like 3 months, 3 months or 6 months. Okay. And you expect to earn, specifically you expect to earn interest and get your principal at the end. Okay. So that's something you must understand. So why do we say that fair value through OCI or what? It's because through OCI or through profit or loss. It's because you'll be having changes in what? Changes in fair value. Remember, the fair value cannot remain the same. So changes in the fair value, the gain or loss, where should you recognize that gain or loss? Can you recognize that gain or loss in under OCI or profit or loss? Okay. If you're measuring a fair value through OCI, then any gain or loss must be recognized under that section of OCI. Then if you're measuring using this fair value through profit or loss, any gain or loss must be recognized under your other incomes, or under it could be, let's say, administrative expenses. If it's a loss. That's where the difference is. In case there is a change in fair value, where can you report that figure? Or where can you recognize that figure? Okay. So as long as you're using amortized cost, the initial measurement, you put into consideration the transaction costs. You put into consideration the transaction cost, like legal fees, professional fees, and other. Let's look at a number. Let's see the questions.
Yes.
Okay. So here we have, if we do this, then you will do the model paper question. It's the same thing. KK Limited has an investment in the debenture of ABC Limited. Before we proceed, what does this one mean? Who is the issuer? Who is the holder? KK Limited has an investment in the debenture of ABC Limited. It means that ABC Limited issued a debenture, okay? And you as KKL, you gave money to, you gave money to ABC, okay? So it means that KK Limited is the lender, okay? The lender, okay? If you want to understand this, is like a lender. Okay. So if you're a lender, you're like an investor. So you will be recognizing a financial asset in your books. Okay. Is it clear, colleagues, to you? Is it clear to you?
Yes, it is.
Okay. They are telling us a nominal value of shillings for 425 million purchased on their issue on 1st April 2020 at a discount of this, and carrying a 6% coupon. Okay, this is very key. A KK Limited plans told. Now your objective, what I was telling you, are you going to use amortized cost? And are you going to use fair value? What is your business model? The reason why you're holding that, the contractual characteristics of the cash flow. Okay, this one plans toward the debentures until their redemption date on the 31st March 2024. So this is the maturity period. So you want to hold this up to the maturity period. So automatically you know that here you're going to use which one? You're going to use which one?
Amortized cost.
the amortized cost. The yield to maturity of the debentures is 7.76%. Okay, the yield to maturity. KK Limited is seeking advice on the relevant accounting treatment of the above instruments in its financial statement for the year ended. Now, this is for the year ended. This is before you're preparing the financial statement, before the maturity period. Okay, so add at this date, what should be recorded in our financial statement? Yes, you are holding the debenture until the redemption date. But that one doesn't mean that you shouldn't recognize in your financial statements. You must recognize. Okay, so we are going to write and say, this is practice question 1. We are advising, so it can be a report format, but here we don't need it to waste time. Right? Even if they say you advise without mentioning you do a report, you should use the report format. Yeah? So here initially we just needed to know this transaction. This transaction must be accounted for. In accordance with IFRS 9. That is financial instrument. Okay, since they must recognize the financial asset in their financial statements. Okay, initially this standard requires initially IFRS 9 requires an entity like KK Limited to recognize the investment in a debentures, that is the financial asset. At a cost. Initially, they must be measured at a cost as below. Okay. So here, if you're to, of course, here in your record is entries that you're going to debit. This is an asset. So you debit an asset, the financial asset. And this is what? The investment. In your books, you will have that item called investment in debenture. Debenture. And that is how much? Actually, we don't have the transaction cost, so there is no need of, but we have a discount. Yeah? We have a discount. You could just get your cost or the fair value or the price paid, then plus the transaction cost. But here we don't have the transaction cost. So you will simply get the 425 million, then minus like a discount. Yeah? That's what you will do. Then here you'll be in a position to get how much? That is 400 million. So that's what will be. That will be your financial asset. Then you credit. Remember, you as the KK, your cash or bank are reduced. That is initially. Then subsequently, what should be done? Subsequently, what should be done? Remember the model this company is using is to hold the debentures until the maturity period. Okay. So we are going to say that subsequently this financial asset, this financial asset should be measured at amortized cost, since it is held until maturity to correct the contractual cash flows. Correct the contractual cash flows. Okay. As below, you can put as below, or refer to the appendix as below. So what you're going to do, you're going to create a table. Balance brought down is like the amortized cost at the start of the year. Then since this is an asset, you will have a column for effective interest income. If it's a liability, here you put the interest cost if it's a liability. If you are in the books of the other entity, Then you also create another column for coupon, interest, coupon. Okay. These are like the cash flows. The cash flows. In short, your coupon. What you expect to be receiving. Then the last column is balance carried down. The amortized cost at the end of the year. Okay, so you can keep your figures in million. We say shillings in million, so that we save time. Made an investment on 1st April 2020. So the our first year will be 2020, 2021. Okay, that will be our first year. We have to report on 31st March 2023. So the first year will be 2020. Our first year will be 2020, 2020, 2020, 2023. Okay. Then here it's no, 2020, 2021. Then here it will be 2021, 2022. Then 2022 to 2023. That's what you need. Okay. That's what you need. Or you put the period like from first April 2020, then to 30th, to 31st March 2021, like that. Then here you put first April 2021 to 31st March 2022, like that, up to 31st March 2023. But even this format can work. The question is here you're starting with how much? Initially you have 400 million. So that's what you're going to put here. If at all we are using fair value through OCI or fair value through profit or loss, you need to be very, very careful. Very, very careful, right? Okay. So here you put the initial cost. Then next, how are you going to get the interest income? How are you going to get the interest income? You look at the effective interest rate. This is the effective interest rate from our question. The effective interest rate is what? This is the one that should go to the profit, the income statement. The effective interest income. This is a coupon. This is just the coupon is just going to help you to know your cash flows. For you, as you look for the amount to be recognized in the income statement, you must use this one, the effective interest rate, or the yield to maturity, 7.76. This is 7.76. Then the other percentage of 6%, you put it here. As you get your cash flow, these ones must be at 6%. These ones help you to know the movement. This one, the one you put here, affects your income statement. What you put here just goes to your cash flows, your cash flow. Okay. In short, this is the actual. Amount. How do you get interest? You get the 7%, the 7.7% times 76 times this. That's how you get your interest income. Then how do you get your cash flow, your coupon? To get your coupon, always know that coupon or the cash flow is the rate attached on the debenture, that is 6%, then times the par value, the nominal value, times the nominal value, the par value, nominal value. This one, don't remove the interest, rather the discount. Don't remove the discount. Here it's the value of the debenture. without removing the discount. So here it's 6% times the what was the value? 4.425 million. Don't remove the discount. The real value, the par value of the bond is 425 million. You don't remove the discount, which is equal to how much? That is 20. Is it? Let me see, 0. Let me just do it from here. This is 6% times 425. So that is 25.5 million. So this one will remain the same. This one will remain the same. This one will remain the same up to the maturity period. But of course, at the maturity period, your cash flow, the cash flows will be, remember the contractual cash flow is the interest and the principal at maturity period. So when you're dealing with, let's say 2023, 2024, what you put here, let me just do it. What you put here, colleagues, is the principal amount plus the redemption value. So here it will be, you get the 25.5 plus the redemption value, which is 4.425. That's what you put. Okay? At the end. That's what you put. Then here you just simply, these ones you put them in brackets. These values you put them in brackets because they are just cash flows. Even here you put these values in bracket. They are cash flows. Then to get the balance carried down, you simply get this balance plus this. Then you subtract your cash flow. The balance you have here, put it here. You put this balance here. And you do the same here. You get the rate 7.76 times the balance brought down. Then the answer here, you also do the same. The answer here, you do the same. So here it will be this. It will be this. Then here you get 7.76 times this. Even here, if you were to do 2020, 2024, 2020, rather 2023, 2024. Remember, for our part, we don't need this, just for illustration purpose. You do the same. Here. It's 7.6% times this. But is this value correct? 7.76% times this. Okay. So at the end, the answer must give you 0. The answer must give you 0. Just you see these ones, it's because of decimal points. It's because of the decimal points. But at the end, the answer should give you what? Should give you 0. If you round off to a whole number, I don't know. If you round off to the whole number, you get a 0. At the end, colleagues, at the end, at the maturity period here, the balance must be 0. My balance must be 0. But for us, we are interested in this. We are just interested in the year 2023 to rather 2022. This is what we are interested in. This one. That's what we are interested in. What should we report in that period? So you will just say for the year ended 31st March 2023. KK Limited should recognize the following. One, they must recognize the financial asset at its carrying value of shillings. What is the carrying value? You come here for the year 2022-2023. This is our carrying value. So you recognize 418 million. In what? In the statement of financial position. Are we together, colleagues? That is number one. Then number two, what can you recognize in your income statement? An interest. So you recognize an interest income of shillings. How much? 32 million. In the statement of profit or loss. Then number three, if you prepare a cash flow statement, then you recognize the coupon received. Of shillings, this one, 26 million as the cash inflow. This is now cash inflow. As cash inflows from your investing activities in the statement of cash flow. And that's all. With that question. That's all. That's all. So you use this same knowledge. Don't change anything. Try that model paper. That question in the model paper. Use the same knowledge, and try that model paper question. That is model paper question what? Model paper question 3, note 1. Please, you do it. Like now, other question that we are going to handle, we are going to look at it in a situation now where there is the impairment of the asset. Or what is the impact, or what should we do? So question 3, question 4, and this question, May 2025, the last sitting, just last sitting. Question 3, paragraph 2. All these 3 questions, practice question 3, 4, and this May 2025 question 3 are just testing us on the impact of impairment of the financial asset. How do we handle? Then Here, I'm going also to talk about the compound instruments. In a scenario where you are dealing with, let's say, convertible debt, like convertible bond or convertible debenture, how should you handle such kind of question? And we are going to use these questions.